chapter 3. Okay, we already looked at how accounting is done and how to categorize and whatnot and what the categories are. Now we're going to apply them into actually converting them into an actual transaction. Okay, so first thing that we're going to do is the chart of accounts. All right, so this is the popular thing that you guys need to develop. Number one thing, you need to develop a chart of accounts before even journalizing anything. Now, what if I'm starting a business by myself? I have no idea what kind of accounts I need. That's fine. As long as you're the accountant, you can create your own accounts at any given time. And you don't need to journalize it. You just do it, okay? But for instance, if you're the bookkeeper, you need to have this chart of accounts made ahead of time before you can even have the possibility to even journalize. Okay, so what typically a chart of accounts is, it's a series of all of your accounts. And what it does is it's basically a list of all of your accounts, and it can be broken down into details of what they are. Usually it will give you what kind of type they are, and this is optional, but it is very preferable to have an account number. So what the account number is, it builds a sequence for you so you can recognize your accounts quicker. Also, maybe you memorize numbers more than you memorize the names. So that is a way that it keeps you and your accounts organized. Okay, so it's like a sequence, a series of some kind of method to organize your accounts. Okay. So this is just a quick screenshot of what it would normally look like. So again, you have your account number, you have your account name, and you usually have your account type. In QuickBooks, it's going to actually look a little different from this, but also similar. But you definitely need to have your chart of accounts before starting anything, okay? And the main person that is in charge of this is the accountant, okay? So moving on to once your chart of accounts has been built and it has been it's readily available to use, you're going to be introduced to a general journal. Okay, so again, it's going to look something like this without all the arrows, but you're definitely going to have a column for the date. Okay, you're definitely going to have a column for your description / your accounts. You're going to have a column for your post reference. And then you're going to have the left side, which is the debits. And then you have the right side, which is your credits. Now, there are a lot of things that you see here, so I'm going to break it down from top to bottom. All right, start from the very top. What a general journal is basically a book where you just record your daily transactions. Simple as that. It's a book that you carry around. It could be a journal. It could be just anything as long as you only keep your transactions in there. Okay. Second thing is, it is going to be recorded in chronological order, as in dates matter when you're dealing with journalizing. Okay, that's the number one thing, because we want to, one, make sure that you journalize every day. Second of all, is it also allows you to keep your stuff organized, but also like we generally do it in chronological order. Reason being because if you fall out of order for any reason to start putting it out of order, it's going to be difficult to find your information, and as well as determine, when did you actually buy it? If you put it in order, you can easily recognize it because it's already in order. And generally, if you're recording on a daily basis, it's going to happen in chronologically order. All right. Second thing I want you to understand is you're going to record debit first and then credits last. What does that mean? So if you look here under the description, so the description can entail three things. You're going to have your debit account and you're going to have your credit account. And then the third thing is you're going to have your actual description. Okay? So what that means is when you're doing your debits, it's going to always be left aligned. Okay? It's going to be the first thing that you recognize, and it's going to be the first account that you list. Okay? Any account that is a credit is going to be determined with a indent, or if you use Excel, you can actually just have the cell over. But usually it's identified with an indentation. Okay. Now this rule has to apply when you're doing proper accounting styles. It always has to be debit first and then credit last. Never, ever, ever, and I think it goes against the rules of GAAP as well, to have your credit go first and your debit go last. Okay. This is also for visual appeal. You generally would, it's also easy to recognize as well. If you look at this just like a paragraph, you can tell that the first line is the most important one. The second line, not so important. But at least you'd be able to know when the separation of the next account is going to be because of the indentation. All right. And your description, you have flexibility and choices with this one. All that you really do need is to make sure that you have parentheses around your description. You can have it italicized, you can have it in another font, you can have it whatever, and your description could be whatever you want to make sure that when you're recording this transaction, it gives you as much details about this transaction. Now, I could, like I said, I could have put furniture, right? And I put cash, right? But what is my real transaction at hand? If I'm someone else and I'm looking at my books, I'm going to be like, okay, you bought furniture, but first off, where did you buy the furniture from? How much did you buy the furniture from? What kind of furniture did you buy? So that is where the description is going to allow you to enter in as much detail as it is for you as the accountant or bookkeeper to recognize what this transaction entails. Okay, and this is not the only place that you would actually place that information. When we get into talking about financial statements, you do have what's called the in the next chapter, chapter 4, you do have a place called notes to the financial statements, and that's where you can actually pour in all your information as far as detailed wise, like anything that supports the financial statements or anything that a transaction that you couldn't explain on a journal because you have such limited amount of space, then you would refer to the notes to the financial statements. But in this case, what I like to do is I normally like to put in where I got it, did I write a check to it, just small details like that, okay? We'll go in either parentheses, italicize, whatever you want it, as long as it's after the credit and it's in parentheses, okay? Next thing that we're going to talk about is going to be your post-reference number. Now, your post-reference number will always be your account number that you associate in your chart of accounts. Now, you don't have to have a number per se. It could be like A for assets, and then it could be a couple digits later after that. Whatever type of sequence that you use to separate or to categorize or to place them in a sequence is whatever you're going to post in your post reference. So for example, furniture. I wrote that furniture is going to be my account number 10400. Now, oftentimes it is associated with numbers, and we could talk more into detail about that when we actually look at a chart of accounts in our fictitious business. But typically, account numbers are used by either 10,000, 2,000, 3,000, 4,000, 5,000, etc., etc. They're usually grouped in they're usually grouped by the first digit being a 1 or the second digit being a 2. That's the general consensus. But again, if you're looking at a major corporation that has billions of transactions, you can definitely know that they probably use numbers and letters to just create a unique account number. So typically you would find your post reference would be whatever number that you associated the account with under your chart of accounts. Lastly, when you enter in your debits and credits, the one thing that you have to do before you can say this journal is complete is that your debits must match the total number of your credits. Okay? So if I have, and this is exactly what a double entry journal looks like. If I'm buying furniture, I'm increasing my asset by $500, so that means I better spend or get rid of or decrease my cash value by the same exact amount. Okay? So your debits must always equal your credits when you're journalizing. And this will validate your double entry system. Okay? Any questions about the general journal? Okay?
No.
All right. So next thing that we're going to be looking at is going to be transaction analysis. So there are a total of 7 steps to actually recognize whether a piece of financial information is even significant enough to record. All right. So first step to even begin transaction analysis is number 1. When you receive your source of your source document, whether it's a receipt, whether it's a contract, an invoice, a bill, right? That's considered a source document. And once you receive that, you're going to recognize to see what the transaction is at hand. What was the event that happened, right? You want to try to analyze it, try to understand it, as well as kind of make sure that you have a physical copy or proof, again, source document that this transaction has happened, right? You're gonna once you receive it, you got to analyze it to see what this transaction is even about, okay? And then second thing is you're gonna understand how this transaction affects your business, right? If it's a water bill for your house, does that affect your business? No, because that's for your personal asset. That's for your personal home, right? But if it's a utilities bill for the building that you're renting, for the store that you're operating, then yes, you kind of think about it. How does this transaction affect your business? And if it does, in what way? And in this case, I got a utilities bill because I used a lot of electricity to turn on the lights in my store. So yes, this does affect my business. So what the third step is going to be is how are you going to determine what accounts you're going to that are going to be affected whenever the transaction occurs. So understanding that, does it increase or does it decrease the account, right? So this is where I receive my utilities bill. So that means I have utilities expense. And therefore, I have the choice. Do I want to pay now? So do I want to spend my cash now? Or do I want to hold it off and pay it on the due date? So am I creating a liability? Or am I going to just pay it now with my asset, with my cash? So understanding the transaction at hand and determining what accounts are going to be affected, and are you going to increase or are you going to decrease? And then number 4 is you're going to, now that we have 3 accounts that are possibly going to be affected, right? We have a utilities expense, we have accounts payable, and we have cash. Now I'm going to go to my chart of accounts and I'm going to recognize what accounts are actually available to you. Okay, so I'm going to go into my expenses, and if I don't see a utilities expense, do I see an electricity expense? I do. Then I'm going to I'm going to make sure that I take that electricity expense and apply my bill to that. Now, my question is, am I going to pay now? So am I going to use my cash account, or am I going to pay later? So I'm going to owe that amount by creating an accounts payable. And I say I'm going to owe the money because the bill's due in 2 weeks. So I'm going to create an accounts payable. I know for sure I should have an accounts payable, but I'm going to look it up to make sure that I have it so I can correctly journalize it. All right? Anything that does not exist in your chart of accounts, if you're the accountant, create the account. If you're the bookkeeper, you got to go ask the accountant to create that account. Say, there's no utilities expense or there's no electricity expense, create the account. And once you've done that, then you can go ahead and proceed with journalizing. So again, step number 5 is you're going to use the debit and credit system. So use the rules, like where are you going to debit a certain area and where are you going to credit. So obviously, expenses are debited. So I'm going to debit my expense. And then obviously a payable is a liability. So I'm going to credit the account. And then lastly, number 6 is to determine what journal to use, which is pretty straightforward. Yes, a company can have multiple books. You can have one for just inventory, one for just sales, one for operating expenses. You can have multiple books. So make sure you know which book that you're going to dive into to record this transaction. And then lastly, number 7, do it. Just record it. All right? So that is the 7 steps of transaction analysis. Now, this is easy if you've been doing it for years, recognizing a transaction, boom, boom, boom. It's easy. But if this is your first time, I actually generally want you to actually kind of look at this scenario and actually utilize these 7 steps. Understand what the transaction is at hand. Go ahead and determine, does this affect your company? If it does, then okay, I need to determine which accounts. Now, most account names are generally associated with the basic transactions, right? Utilities expense. It's not going to be under some ridiculous name that you would have not have guessed. It's not going to be some other type of expense. It's going to be generally fairly easy to recognize. It's pretty straightforward when you're recognizing the accounts. And then, just doing it. Just when you once you get into the journal, you'll know what to do from there. You're going to use your debit and credit system. You're going to write your account number and you're going to write which accounts apply. So, yes, so that is the 7 steps of transaction analysis. Now we're going to be moving into correcting entries. So oftentimes if you are a newbie or even a long-time person who's been journalizing for years, you will incur making minor mistakes in journalizing. Okay? And a couple of rules when it comes into journalizing is if you make an error, strict rule is you cannot cross it out, you cannot erase it, you cannot take a white out and white out your transaction, because that's considered right there instigation for fraud. Okay, that is you trying to scratch out something in a journal, trying to erase a transaction, which again, this is why we have the rules, is because we want to prevent that from happening. So we don't cook our books, right? We're not trying to get rid of transactions, right? So in order to be able to fix those entries, you are going to be looking at 2 different types of methods that you can fix your error in your journal. And that's going to be, the first one is going to be reverse and reentry, and the other one is error cancellation. Now, reverse and reentry is pretty straightforward. you're going to reverse the transaction, and then you're going to re-enter it with the correct amount. Straightforward. Error cancellation. You can make many mistakes with error cancellation. Now, what error cancellation does is you're going to look at the transaction, you're going to compare your mistake, and then you're going to record the account again and transfer the difference into that account. And that's very difficult if you're not understanding where to go as far as maybe about too many supplies. I can accidentally journalize more supplies instead of taking it out. So error cancellation, if you're really good at it and you really understand the transaction at hand, use it. But in this case, preference-wise, the easiest way to fix your mistake is to just reverse the transaction and just re-enter it. Simple, easy, okay? So let's go ahead and look at the very first scenario here. It's going to be the reverse and re-entry type of correcting an error. So here I have an example. In September, on September 15th, okay, you purchase office supplies with cash, okay, and you bought it for the amount of $65, right? And then sales tax, of course, is included. I'm just making a round number just so for the sake of explaining the example easier. So you have 65. You bought it for $65, right? You go and record the transaction, and you record it as $56. All right. Now you need to correct this entry. Okay. So now, by looking at this, you have understated your assets because you wrote that you only have $56 worth of office supplies, when in reality, you're supposed to have 65. So if you're really good at this, you can understand that I need more supplies. Therefore, I need to have less money, which in this case, you said that you paid only $56. Now, I don't know the scenario in this case. Like, did you pocket your own money out of this? If you did, then you should know how much money you have in your wallet. But in this case, we recorded it wrong because we decided to come home. We're so tired. The receipt is somewhere. But I remember I bought office supplies. I recorded it for $56. You know, just that one. Now, in order to do the reverse and re-entry, we're going to think about it like this. So I bought supplies. I bought it with cash. Now, in order to reverse the entry, I'm going to go back to the store and I'm going to return it. So that is exactly what you're going to do. You're going to get your cash back and you're going to return the supplies that you bought for the amount that you originally written it for, $56. Okay? And then to re-enter it, I'm going to go back and I'm going to repurchase those supplies. And this time, I'm going to repurchase them for the correct amount, which is $65. And in your journal, you should write to correct the error from this date. Okay? So that is how you do the reverse and re-entry. Okay? You bought supplies. You wrote it for the wrong amount. So what I'm going to do is I'm going to go to the store, return it, and then I'm going to come back and buy it again. That's the easiest way I can explain this one. And then when we're dealing with error cancellation, oops, I'm supposed to have a slide before that to hide all the answers. But with the error cancellation, what you're going to do is, okay, I'm looking at my transaction right now. I recognize right here that I am missing some money in my supplies, and I'm also supposed to be less. I have less money in my pocket. So what I'm going to do is I'm going to find the difference between 65, which is the original amount, and for the amount that I have recorded it for. And I'm going to go find the difference. And my difference is $9. So what I'm going to do is I have to think really hard now. Right now, what I'm missing is I'm missing $9 of supplies. So I need to increase my supplies by $9. And that is what I did. And I counted the money in my pocket, and I'm missing $9. So therefore, I need to subtract or decrease my cash by $9. Okay. Now, common mistake is some people, they don't understand it. They try to fix it, and what they do is they not reverse, but they confuse the two and say they actually wrote that they are supposed to increase their money by $9 and decrease the office supplies by $9. So you want to be very careful when you're using error cancellation. All right. And then T accounts. Now, oftentimes when you are trying to make a quick calculations, your journal, on the side of your journal, you're more than welcome to just do a real quick tally up of how much money you have in your account. Now, so what the purpose of a T account is when you need to find out a quick way to find a sum or a total or a balance in any given account, right? On the side, you just write the account number. Okay, well, I started with $51,000. I'm sorry. I started with $5,124. I deposited. What did I do? I got sales so I increased my cash because I made cash sales for $154. I had to pay rent for $500, and then I also had to buy office supplies for $65. Okay, so how the T account looks is pretty straightforward. It's a small graphic depiction of the debits and the credits, right? You have a T-shaped table. Your left side is going to be your debits, and your right side is going to be your credits. So just like that, and you can find the total in an instance, just like that. Now, I'm not going to test you on this, but I do want you to recognize that this is a quick and easy way for you to calculate your balance at any given time. But we also have the general ledger for that. So what the general ledger does is it basically keeps track of all your transactions, but it gives you a running balance. It lets you know if you made one transaction today, at the end of the day, this is how much amount you're supposed to have in a given account. So that is the true difference between the journal and the ledger. Is the journal, you're just doing day-to-day transactions, right? You're not recording a balance. You're just recording as is. Where the ledger is you're actually knowing how much you have at the end of each day in each account, in the balance wise. So for this example again, I use cash again. So here on August 31st, I should have 5,124, and every entry I've made will give me a balance at the end of the day. So for my first transaction on the 1st of September, here I entered, I had sales. So I got cash sales, so I received another $154. Therefore, my new balance is going to be $51.78. So every transaction that you do and you record into the ledger, it's just going to automatically produce a running balance. Okay, so it allows you to know how much money or how much is in your account at any given time. All right, and you post to the general ledger after your transactions have been recorded to the journal. Okay, so when we dive into tomorrow, we will learn the 10 steps to the accounting cycle. And so the very first thing that you need to have before anything is you need to journalize first. After you've journalized, that's when you can go to the ledger. Okay? So you need to have the general journal recorded the transaction in the journal first before you can post it into your ledger. All right. And then course review is going to be, I did tell you what a chart of accounts is. I exposed to you what it was. I also exposed to you what a journal is, a T account, the different types of way to correct a journal entry, and then lastly, here I gave you a little description, difference between the journal and the ledger, right? Again, the journal is just day-to-day transactions. You're not having a running balance. The journal, the ledger is going to have a running balance. Okay, so that is it for chapter 3. Questions about chapter 3?
I do have a question.
Yes.
In reference to the reverse and re-entry method,
Uh-huh.
so you found can you correct that the following day, or it has to be done the same day?
You know what? You can, as whenever you recognize that you made an error, it can happen 2 days from now, it can happen a week from now, it can even happen a month from now. So typically, again, when we go through your journal entries, right? You definitely need to have your source document, like a receipt attached to it, right? And the purpose of, if in case you do make an error, you definitely want to look at all of those receipts and making a double check that you've recorded and you entered it in correctly in your journal. Now, if you do find this error, let's say 2 weeks later, yes, you can correct it 2 weeks later. All right, you just have to make sure that, again, when you're journalizing, the day that you find the mistake, you record it that day, and you make sure in your description that you're correcting the error made on that specific date. So in case you see right here, I wrote right here to correct the error on the 15th of September. Okay, so sometimes you can find it the next day. Sometimes, if you're lucky, you can find it the day of. But again, if you're dealing with hundreds of transactions, it could slip by fairly easily. But again, the purpose of being an accountant is making sure that when you journalize, that you have your source documents to back it up. All right. Any other questions?
I have one.
Yes.
When you were talking about the reverse and re-entry, you said you physically go to the store and return the things, the supplies?
That's just an example of what
Like
you
you
would.
physically have to go back.
You don't have to physically go back. Oh,
Okay,
of course
I'm glad you
not,
laughed.
because that's how I interpret it, is like to understand, because I had a student, she didn't understand why we need to reverse the transaction. Okay, but when we're looking at reversing the transaction, it didn't make any sense to her why we needed to return the items, or why what the reversing entry does. And essentially, if you think about it, it's in terms of, yes, you are returning the items. You have to return the items. That's how you reverse a transaction. That's how you zero out your
So
transaction.
figuratively,
Figurative,
returning the items,
yes.
not physically.
Yes.
Got you.
Yes.
Got you.
Yeah, that's the best way I would reinterpret reverse and re-entry is, you bought the supplies, you would figuratively return the supplies and then repurchase them. And in a sense, then yes. So you entered it here, you're gonna reverse the transaction to zero out your transaction, and then you re-record it with the correct amount. Yes. So yes.
Question again.
Yes.
But isn't that the what you call this? Granted, instead of returning all those kinds of things,
Mm-hmm.
isn't that when you enter the error cancellation method though? You apply.
Okay, so let's look at this scenario, right? So this is reverse and re-entry, right? You're reversing and canceling out the original entry. So you're essentially you're zeroing out that transaction by debiting your original credit for the same exact amount. And when you re-enter it, you're going to re-enter it with the correct full amount, which is the $65. Where error cancellation, if you're really good and understand how the transaction is at, you don't need to reverse it. You just fix it by moving the money of value or by entering a value into the correct location that it's missing. So in this case, instead of journalizing it for the full $65, we're only journalizing for the missing $9.
Okay.
Okay, so they're two separate ones. You can only choose either or. You cannot do both.
Okay.
Okay. Oh, that's a good one. You can only choose one or the other. You cannot do both, or else you'll double cancel out your transaction.
Yes. Yeah.
Okay. Any other
And
questions?
and when it comes to, granted, you're done with those paper documents like that, you'll just have to attach all those supporting documents or the receipts when it comes to submission.
Um. Yes. Yes. Generally, now that we're kind of going digital, you'll just have it as a digital copy, or you'll have it backed up in a folder. So you'll have a book, right? Your general journal book of transactions, and you'll either have a flash drive with all the scanned documents that are associated with it. Since we're going digital, it's not going to be like a shoebox full of receipts and the book on top. You're not gonna no.
Yeah, yeah, yeah.
But yes, generally, a good way to keep track of it is yes, you could staple it behind the transaction. That's fine too. But that's looking at an old school standpoint. But generally, yes, you would fix your errors. When you fix your errors, obviously you only have one receipt to validate this transaction. So when you actually fix it, there's no actual extra document you need to attach to it. You just need to make sure you attach the original to this one to validate that you made a mistake and this is the correct amount. Okay? But good question though. That's actually a really good question. Never thought about that. Mm-hmm. Any other questions?
I have a question.
Yes.
So when you say you can only use one of them, do you mean like per error or like per like book that you're using?
Per error. Yes.
Okay.
So again, like I said, I prefer you guys because you're more likely to create more errors if you use the error cancellation if you don't know what you're doing. So I would prefer you to do the reverse and reentry. And of course, if you're a newbie to journalizing, you're going to make error after error after error. So of course you can use any method that you want, but you want to make sure that you stick with one method and make sure that you do it for each transaction that you have an error for. But yes, I've seen where if it's something very, very small, such as, oh, I accidentally put money in my accounts receivable when I needed to put it in my bank instead. That one, error cancellation could solve that quick. You don't need to reverse the transaction just to re-record it. So something like that, something really, really small, boom, just do it. But it's for every single error that you find in your book. Okay. Now, when I say do one or the other, if you're going to fix one error using the reverse transaction, the reverse and reentry, you cannot correct the same error with also using the error cancellation because that will defeat the purpose of your fixing your error. You're gonna double the error by doing that.
But that's using two different formulas as well.
Yes, yes, yes. There are they. Yes, yes.
Okay.
Okay. All right. Any questions? So, for when we look into our case study later on, we will be we'll make a mistake on purpose for our journal. I mean, for our class scenario. So we'll get to see this in live action on what do you need to do and how to fix that error. Okay. And I've the last class I did the case study with, I actually made another error, so we got to look at both errors and how to fix them. Okay. So, any other questions in regards to just knowing anything about chapter 2 or chapter 3? Again, this is, I guess, this is the beginning. This is it, the final step before you can actually start journalizing. All right. So, if you don't have any other questions or anything about that, tomorrow again we will go over the exercises in the beginning of class before we dive